Hello, everybody, and welcome back. Chinese equities have been through 2 difficult years. The end of the strict COVID lockdowns had caused a short-term upswing, but geopolitical tensions are weighing on the Chinese stock market. Today, I talked to Jonathan Pines, lead portfolio manager Asia ex-Japan at Federated Hermes, about risk and opportunities for Chinese equities. Warm welcome, Jonathan.
Thank you for having me.
Jonathan, international investors have recently withdrawn capital from the Chinese stock market again. Can you relate to the worries?
Of course. I think the key worry that investors legitimately have about China is geopolitical tensions. Geopolitical tensions with the US and the unpredictability that comes with it. We have got a substantial position in China, and we have an overweight to China. So it's the risk that keeps us up at night. That said, we believe that it's a risk worth taking because the prices on offer are so attractive. So in a portfolio context, and that is how I think China needs to be viewed, we believe that the price that China is available at now, which is a record low relative to the rest of the world, makes it a risk worth taking.
So we'll be touching the valuation question in a second, but financial markets celebrate China's reopening after the harsh lockdown measures. Since then, the MSCI China has fallen significantly again. So is the party already over again?
So I think what happened, if you trace back the path of Chinese equities subsequent to the abandoning of zero COVID, is that there was initially a lot of optimism because zero COVID was perhaps the key negative that international investors were focused on before it was lifted. And the initial reaction of the stock market to the lifting of zero COVID was very positive, but that momentum failed to carry through. And I think it was for 2 main reasons. The first one is that geopolitical tensions again reemerged. So you had famously this incident where a balloon was shot down by US authorities, a balloon over US airspace, which really contributed to a very negative perception of the relationship between the US and China. Tensions were exacerbated. There was a lot of back and forth about that, and various meetings were cancelled. So that was the first thing that held back the rally. And the second thing, I think there was general disappointment as to how quick the recovery was in China. I think most investors expected China's experience to exactly replicate the experience in the West, where we saw a sudden recovery in many sectors when zero COVID was abandoned, and or certainly when the restrictive measures of COVID were abandoned in the West. And you didn't see that same quick response in China, maybe because the downside was more muted in the first place, so that there was less of a coiled spring, I guess, to release in China. But I think the combination of a slower trajectory of recovery plus the re-rearing of geopolitical tensions was what disappointed the market following the lifting of zero COVID.
Are Chinese stocks cheaply valued at current levels? And what needs to happen for Chinese companies to reach another higher valuation level again?
They are cheaply valued. So as I mentioned previously, we're now at a record low valuation relative to the rest of the world. And the interesting thing is a lot of risks have got better. So although we continue to be at a record low relative to the rest of the world in valuations, there have been some risks that have got better. So for example, zero COVID, of course, has been lifted. 2, the government is more pro-business than it was. There was a time when investors began to fear that the government really wasn't acting in the interests of business at all. Famously, the education sector was pretty much wiped out last year because of government common prosperity, inverted commas, policies. So, and subsequently, the government has definitely softened its stance on business, as perhaps best illustrated by the partial or maybe even fully bringing of Jack Ma in, who was the poster child of a negative business-government relations in Back from the Cold. So there are at least 2 key risks that have got better. The government's more pro-business than it was last year, and zero COVID has been lifted, and yet valuations continue to be at record lows, which must mean that investors have become all the more worried about geopolitical tensions. Now, we think that we are worried about geopolitical tensions too, but we don't think they have deteriorated. In fact, this week, Blinken, which is the US Foreign Secretary and Secretary of State and the Chinese counterpart are meeting. And there's just as much potential, we think, for geopolitical tensions to improve as they are to deteriorate. And in the context of record low valuations, we again reiterate, we think it's a risk we're taking.
Consumption is increasingly becoming the driver of Chinese economy. So what opportunities does this trend open up in the long term for you?
Until now, the Chinese economy has been dominated by export and fixed investments. It's long been a standing policy of the Chinese government for the consumption part of the economy to be better. And we think that that's naturally been occurring, and it's going to be, in addition, it's going to be pushed by the Chinese government too. And essentially, it's going to open up opportunities wherever there's consumption, be it travel, which is jewelry or advertising or the internet space, and really everything directly or indirectly related to consumption. Now, as stock pickers, for us, it's always going to be price versus value. But certainly the value of consumption companies has got potential to re-rate upwards as that sector gets encouraged by the Chinese government. And we will consider the price in relation to that enhanced value that results from government support, and also a general rebalancing of the Chinese economy towards consumption and away from exports and property and other fixed investments.
So we have seen that you are heavily invested in technology stocks. So where do you see current opportunities in the Chinese stock market?
If we look at our portfolio in Asia ex Japan, we have got a very strong value bias. The one partial exception to that is within China, both value and growth stocks are attractively valued because China trades at a record low relative to the rest of the world. So in terms of which particular technology stocks we think are attractive, we're in quite a range of them. We are in the likes of Baidu, which is the Google of China. Now, if you do an analysis that we've done, we reverse out their cash and we reverse out some of their key non-core holdings. The core business is trading on a mid-single-digit PE multiple. So we think that that is exceptionally good value. And although it's a technology stock, it's not priced like a growth stock. It's priced like a value stock. We also own Weibo. It's the Twitter of China. Again, the growth, I wouldn't say it's a growth stock anymore. It's a technology stock. It's not a growth stock. And it's priced like a value stock. So it's priced on a PE of below 10 times. And we're finding increasingly that traditionally tech stocks, which have traditionally been considered growth stocks, are now priced as value stocks. Now, our hope would be that they'll grow and they'll grow quickly. And we'll be able to benefit both from the growth and also the revaluation, the repricing. And a number of the companies we have, we think have got that margin of safety in that they have the potential to grow, but they're priced like value.
So you already mentioned some of the keywords like common prosperity and measures against the ad tech sector. So also big tech like Alibaba, Tencent, they have been drastically punished by some measures of the government. So how likely is it that big tech in China will see more of these measures again?
We can never say for sure, but I think there has been an increasing realization by the government that it's necessary for business to do well in order for the Chinese economy to do well. And certainly there has been a recalibration in terms of the government's attitude to business. So although we can't discount anything in particular, we think that the government's certainly adopting a more pragmatic approach. I mentioned earlier that they've brought in Jack Ma from out of the cold, who was a poster child of poor relations. But they've also done things like they have approved the release by Tencent of games And previously the government was anti-games. Now I think they're less so, because I think they see the technology advancement potential from it, as well as, of course, underlying all of these things, the employment prospects of these sectors and the necessity to employ their very highly unemployed youth. So the government, we believe, is becoming more friendly. Now, that doesn't mean all these tech stocks are buys. They need to be assessed in terms of the price versus value. Alibaba, you mentioned, it's cheap. The growth is not growing as strongly as it once was, but it trades at around a 10 times earnings multiple, their core business, which is for us attractive. Tencent, it's a great quality company, but after stock-based compensation, it's trading in the high 20s, so it's relatively less attractive for us. So one has to be selective, but I think one thing that we can count on is that the government is going to be more friendly to business than they were certainly last year.
What impact will the US chip ban have on Chinese technology stocks?
It's a broad question. If you think of what the motivation of the US chip ban is, it's to restrict certain industries that might apply that technology. Certainly, I would like to restrict, for example, Chinese military industries or dual-use applications. In terms of its impact on the technology sector and the chip sector, what it's going to do is it's going to spur Chinese investment in those technologies themselves. So various companies are going to be beneficiaries of extremely supportive government programs. Now, for investors, the dilemma is the very same companies that are likely to be supported by the Chinese government to get their chip technology sectors up and running are the same companies that are most likely to be sanctioned by the US. So investors need to tread carefully. But what it does is it opens up the potential for heavily supported technology companies in China. And it also opens up the potential for those same companies to be sanctioned by the West, either in terms of their access to technology or the ability of investors in the West to invest in them at all.
You pursue a value-based contrarian investment style with your fund. So how exactly does that look, and what contrarian positions are you holding right now?
Well, if you look at our strongest relative position, first of all, we bottom-up investors. So we pick the stocks, but ironically, that results in quite significant top-down positions. So we are got a significant overweight to Korea, in fact, more than 20% overweight to Korea. We've got a similar underweight to India. And we've got an overweight to China, we've got an underweight to Taiwan. Those are the four big markets in Asia, Japan, Korea, China, Taiwan, India. Now, the reason why we underweight India is because it's the most expensive market in the world, the most expensive large market in the world. So although we very much like the long-term story, the democracy, the fast growth, the fact that it's an ally of the United States, we don't think it deserves to be the most expensive market in the world. So it's an easy underweight for us. Our overweight to Korea, we see incredible value in Korea, and in fact, similar value to China. But unlike China, Korea doesn't have the same geopolitical risks as China. To be sure, it does have some. You've got tensions on the Korean peninsula with a nuclear-armed North Korea. But we don't see the chances of something negative happening geopolitically as high as we do as far as China is concerned. So Korea is our biggest overweight. China, we have an overweight because we think it's a risk worth taking. Taiwan, we have an underweight because we think that the logic semiconductor cycle has peaked. So that's our country positioning. In terms of the types of stocks, we continue to have a very, very strong value bias. We think that value relative to growth valuations remain extreme.
So this was Jonathan Pines, lead portfolio manager, Asia ex-Japan at Federated Hermes. Thank you very much, Jonathan, for being with us today and sharing your insights.
Thank you.